Hi everyone. So understanding candlestick can be very complicated, especially for beginners, right? So in this video I'll be explaining to you how to understand candlesticks. So when you see a bearish or a bullish candlestick, you will know what happened or how it is, how it formed and all that, because candlesticks are a representation of buyers and sellers at the moment in the market. Now let's get into it. A candlestick is normally represented like this. Green is for the bullish candlestick and red is for the bearish candlestick, right? You should know that this is called a body, right? This is the body of the candlestick. This is the body. And these tails are called wicks. You can call them tail, but professionally they are known as wicks. This is the body and the tail. A bullish candle and this is a bearish candle. Now the difference between a bullish candle and a bearish candle is where the opening and the closing is. For a bullish candlestick, the opening is below. The open is here and the closing is above. So the closing is above the opening, or the opening is below the closing. And for a bearish candlestick, the opening is here, is above, and the closing is below. And these tails that we call the wicks, this is the high of the market, this is the high of the market, and this is the low of the market. This tail, they are all the same, the high and the low. So this is a representation of a candlestick, and understanding candlestick is understanding where it opened and where it closed. So for a bearish candlestick, which is a red candlestick, the opening is above and the closing is below. And for a green candlestick, which is a bullish candlestick, the opening is below and the closing is above. Opened here, closed here, and for the sellers, opened up, closed under. Now we have various types of candlesticks, right? But as a beginner, trying to understand all those candlesticks can be very confusing to you. We have many candlesticks, but in this video I'll be giving you the three most effective candlesticks. And the first one is a pin bar or hammer. So it's called a pin bar or a hammer, and we have the bearish pin bar and the bullish pin bar. Let's go with the bearish first. The bearish pin bar has a longer upper wick. You don't understand? So the wick up is very long and a very little body. So the body is like ×3 of the tail, and the tail up is very long. You can call it a bearish pin bar because it's red and it has an upper tail. A bearish pin bar. Professionally, it has a name called inverted hammer. And for the bullish pin bar, which is a hammer, it has a smaller upper body and a very long tail. So the tail is like, the wick is like ×3 of the body, right? And as we all know, for a bullish pin bar, for a bullish candlestick, the opening is below and the closing is above. And for a bearish, the opening is above and the closing is below, right? So this is a bearish pin bar. And how you can identify a pin bar is by its tail. For a bullish pin bar, it has a down longer tail, which is like ×3 of the body. We stated that the market went down to this point. So these wicks that we call a tail is anywhere the market went to, but it didn't close there. It leaves a print, and this is where it prints this particular wicks or tails. So it came down. The market opened here. Yes, it came down to this point, but the buyer still took the market up and it closed above the opening, which made it a hammer or a bearish or a bullish pin bar, right? And for the bearish pin bar, the market opened here and it went up to this point, but the seller still dragged the market down and it closed below the opening of the market. So this makes it a bearish pin bar or an inverted hammer. I hope you are understanding these explanations. The second one is called an engulfing you can call it an engulfing bar or a candlestick, right? Now an engulfing is normally represented with two candlesticks, the first one and the second one. Let's go with bullish first. Bullish engulfing. So the former candlestick is normally red, and the next candlestick is normally green. And as we said, the candlestick of a bearish candlestick, the opening is above and the closing is below. And for a bullish candlestick, the opening is below and the closing is above. Now what makes this an engulfing candlestick is because the closing of this candlestick closed above the opening of the former candlestick, so it engulfed it, it covered it, it closed above the opening of the former candlestick, so that makes it a bullish engulfing candlestick. Normally it's represented as a green. When you see when the closing of the former candlestick closes above the opening of the last candlestick, which is normally red, and the next one is green, it makes it an engulfing candlestick. Then that means the buyers are in full force of the market and they are in control of the market and they are ready to take the market upwards. Now the next one is the bearish engulfing, because for every bullish candlestick we also have the bearish candlestick. Now the bearish engulfing. Bearish engulfing, normally the first one will be green and the next one will be a red one, longer than the green. So looking at it, as we all know, the opening of a green candlestick is here and the closing is above. The opening is above and the closing is below. So looking at it now, this red candlestick closed below the opening of the former candlestick, so it covered it. It's like inside it, it makes it engulfed, it covered it. So that means the sellers covered the amount of the buyers of the last price and they are ready, of the last candlestick, and they are ready to take the market downwards. So this is an engulfing candlestick, looks like a bearish engulfing candlestick in particular. And the third one is the most easiest candlestick, which is called the doji. Now the doji is just like a cross. Red for the sellers, green for the buyers. This states that there's nobody that is in control of the market, because the market opened and closed at the same point. This is the opening of the market and this is the closing of the market, which states that both the buyers and the sellers are 50-50. So nobody is in control of the market, and it represents an indecision or a continuation pattern, right? So I hope with this, my explanation of understanding candlesticks, you've understood how a bearish candlestick opens and how it closes, and also how a bullish candlestick opens and closes, and also these types of candlesticks, understanding them, knowing them is very critical. Though these candlesticks prints can be found anywhere in the market, but it's not anywhere you trade them. We have critical points in the market whereby when you see these particular candlesticks, you should consider trading them or knowing what next is going to happen, or having an edge over understanding what's going to happen next, or who is even in control of the market. You know, these candlesticks can be found anywhere, but we have critical places that when you see them, you already know that the next thing that will happen is this, or you are already expecting the next thing to happen. Now, candlesticks are very effective and efficient in understanding price chart, analyzing price chart. So I hope my video was helpful to you. See you in our next video.